and have one of those thumbnails that tells you it's all over, sell your house now, the world's ending, dinosaurs are coming back, everything's over, you're fucked. In this video, I'm gonna give you an up-to-the-second analysis at what the real estate market is doing, what the current conditions are, and what it's gonna do in the near future. I'm gonna talk about these 5 things. I'm gonna talk about where the market currently sits. I'm gonna talk about what higher interest rate means for the market. I'm gonna give you my prediction on the near future. I'm gonna compare what's happening now to what happened in 2008. And at the end, I'm gonna give you my action plan and what you should do next. Also, we got Maisie's joke of the day. My name is Sam. I'm a real estate investor. I own a house buying company that flipped 252 houses last year. I also own a rental portfolio worth $34 million that I've been able to buy without using any of my own money. I say that to say I do real estate investing. That's all I do all day, every day, and I have a very, very good pulse on the market. I'm in touch with the top economists in the country and the top real estate investors in the country that deal with single family real estate investing. So I know a lot about this. I have my ear to the streets and I'm here to give you the inside scoop. Number 1, where does the market sit now? Well, we are at an all-time high. I don't think I'm telling you something that you didn't already know. According to CNN, prices went up 18.8% in 2021, which is crazy. That means if your house was worth $300,000 at the beginning of 2021, it is worth close to $360,000 today. That is a huge increase in just 1 year. And according to NBC, inventory is the lowest it's been since 1999. Sorry, I got to text Maisie, who's Maisie's joke of the day, or text grandma who has Maisie. The market is screaming hot, and just because interest rates have gone up, it hasn't really affected a ton right now. So even with those increased interest rates, supply is so low that it has not really affected the market. So that's where the market sits. Now let's talk about what those higher interest rates mean for the market. According to NBC, in January of 2022, the average mortgage was 3.41%. Now, just a few months later, it's 5.35%. So it's gone up over 2% in just a few months. So let's say you can afford a $2,000 a month mortgage payment, which is close to the national average. People don't buy houses based on the price of the house, they buy houses based on the monthly payment that they can afford. So in January, with that 3.41 interest rate, you could afford a $370,000 house paying about $2,000 a month. Just a few months later, that same $2,000 a month payment will only buy you a $313,000 house, meaning you lost $60,000 in buying power. That would make you probably think that people are not buying as many houses because they can't afford as much house. However, we have not seen that be the case yet. I know you'd like to see me say the market is crashing and have one of those thumbnails that tells you it's all over, sell your house now, the world's ending, dinosaurs are coming back, everything's over, you're fucked. But that's not what I'm gonna do. I'm gonna give you the real honest truth as to what's happening and what's going to happen. So you can't afford as much of a house because interest rates are higher. Guess what? That's not going to crash the market because of supply and demand. There are so many people looking for houses and there are still so few supply of houses out there, that's not going to matter. My house is a perfect example. I listed my house for X amount. I got $70,000 over asking. I'm talking about my personal house now, and it was all cash. The fact that there are so few houses out there and so many people still looking, that interest rate fluctuation is not going to kill the market because some people are going to pay cash. The interest rate could be 25%, but if you're going to pay cash, it doesn't really matter. So right now, there are still enough people out there that put a lot of money down or pay all cash that an interest rate increase is not going to crash the market. It's just going to slow down those people that we're going to finance. In my opinion, the Fed is just trying to pump the brakes on the real estate market by increasing the rate so drastically. The market was like this. They know, I know, you know, that's not sustainable. They don't want it to crash. They don't want it to be even. They want a slight raise, and that's what they're trying to do. They're pumping the brakes. They're going to get an idea of what the landscape is doing, and then they're going to tick the rates up, or guess what? They're probably potentially even going to tick them down a little bit if they feel like it's really, really hurting the market, because no one wants the real estate market to crash, and it's not gonna. All right, let's compare the landscape now to the landscape of the Great Recession or the 2008 crash. First, I want to get across. There has been one real estate market crash that has caused a national recession, and that was 2008. The other one was the early 1930s, the Great Depression. Real estate didn't cause that, but real estate was affected by that. All other recessions and all other real estate dips have not been crashes. And crashes is a drastic decrease in values of houses. Yes, they go up and down, but there has never been an '08. And the reason there's never been an '08 is because things got out of control then. There were adjustable rate mortgages. People were lending money to people that could not afford the houses they were living in. I spoke with someone who was in the mortgage industry, and they literally told me on their first day, they were handed like a huge textbooks about mortgages and about the company, and then they were handed whiteout. So they could white out people's application and put whatever income was needed to afford that house. Meaning somebody that could afford like a $200,000 house, realistically, they were allowing to buy a $500,000, $600,000, $800,000 house. That obviously is not sustainable, and that's the main reason for the crash in 2008. It was not just prices going up. Prices going up does not mean crash. Inflation's crazy right now, prices are crazy right now, but you go back 40, 50 years and we're pretty much in the same boat, and there wasn't a crash 30, 40 years ago. So just because there's inflation, just because prices are high, just because interest rates are going up, does not mean a crash. The crash in 08 happened because of horrible subprime loans given to people that could not afford to pay them. Now there are guidelines and strict settings that people have to adhere to if they want to get a mortgage on the property. All that saying, people can afford the houses that they're living in right now. Back then they could not, now they can. So the fact that people can afford the houses that they're living in, even though the prices are high, the fact that a lot of people are paying cash for houses means we're not going to see a huge crash. Now, worst case scenario, I see maybe a flat line or 5% decrease in house values if the mortgage rates stay high. But if they trick back down, we'll go back to exactly where we were because of that supply and demand curve that I keep hammering home in this video. So here's my prediction on what I think is going to happen in the near future. If things start to dip and we start to lose more than 5% of home values a year, the Fed will simply just lower the rates. They don't want to see a crash, and there will not be a crash. Will things happen? Will California lose a ton of value in houses? Yes, because it's California. Will certain markets dip because houses got inflated way too much? Yes, but that is not going to cause a national crash. The near future and the mid future looks really, really good, especially the real estate investing market, because the real estate investing market interest rates, commercial loans from small local banks, have slightly been affected. I used to be able to get a 4% loan on my rental properties. Now it's a 4.5% loan. So it's just gone up a little bit, not near as much as the residential rates. Don't want to go down that rabbit hole, but residential mortgage rates and commercial rates for rental properties are based on separate things. So whether you're wanting to invest in real estate or you're wanting to buy real estate, I don't see a crash coming soon. Are you buying at a height? Yes. Are you buying at a house that's buy for $350,000 today? Is it going to be worth $450,000 in 2 years? No, probably not. Is it probably going to be worth $350,000 to $360,000? Probably. Will it maybe be worth $330,000? You never know, but that's not a crash. You're buying now, and if you're buying to hold the properties to live in or to rent, I'm very confident that in 5 years it's going to be worth much more than you bought it for. In 10 years it's going to be worth probably double what you bought it for. Real estate is still a great place to invest. Crypto does this, literally, and the stock market does this. Real estate does this, and people get freaked out by little bitty dips or potential crashes because YouTubers want to get views, so they have horrible thumbnails. Before I talk about what your next move should be, let's give you Maisie's joke of the day. And if you enjoyed this video or want to learn more about how I built my rental portfolio or how we flip over 250 houses a year, make sure to hit that like button, make sure to subscribe as well. What did one wall say to the other? I'll meet you at the corner. That was one of the worst ones I've ever done, but hey. All right, here's the action plan. I put together a 5-part series where I talk about tangible steps you can take to start to invest in real estate now. Check it out. See you on the next one.